Western Iowa Today reports farm income expenditures down in the fourth quarter. This was written in February. Farm incomes decreased broadly across the ninth District, likewise across all of America, according to the lender's response from the fourth quarter Ag Credit Survey from the Federal Reserve Bank of Minneapolis. Joe McMahon is an outreach director with the Federal Reserve Bank. McMahon said capital expenditures, which basically means what you're going to invest in machinery, new parts, or terrace tile, waterways, siding on your granary, whatever it is. Capital expenditures dropped 69%, with respondents' decreased investment in buildings from a year ago. Heh. No shit, huh? Nobody's buying anything. What are the odds? Still, with weak cash flows, weakening demand for loans increased, while the rate of loan repayment dropped and loan renewal and extension activity increased. What that's saying is the amount of money that's flowing as you dump your grain or sell whatever is going to hell because it's not worth anything. Demand for the new loans increased because everybody's in there begging for money because they're broke because what they're selling isn't bringing anything. And loan repayment dropped because what they're selling isn't worth anything and they can't pay their bills. And loan renewal and extension activity increased. Yeah. Hey, banker, give me an extension or we need to readjust this because I really can't pay it. The average cash rent for non-irrigated land decreased by almost 2% from a year ago, while irrigated lands fell 4%. Oh, land prices and land everything's starting to collapse too. Gee, I wonder if that has anything to do with the low cash flow and the increased delinquencies. In my last video, I spoke about gold in relation to corn prices. Gold is not a speculative asset. What is a speculative asset? Well, a speculative asset's an asset or something that you buy that the price goes up because people think, in other words, they speculate, that it will increase, or maybe they're going to speculate that it will decrease. Gold is simply a storehold of wealth, which flat out means it retains its buying ability or buying power. If you had a dollar bill in your pocket, and if you were in the year 1910 or got in a time machine fast forwarded to the year 2025, and that $1 bill bought the exact same quantity or baskets or items of goods, that's what it does. And it's probably going to be your truest inflation hedge, as the value of it does not change no matter how much inflation you have. The dollar bill depreciates in value, means it goes down in value, means you have to have more of those dollar bills to equal what you once had. In a sense, farmland is an inflation hedge. Farmland, now it does go up higher than inflation for other reasons, but it is an inflation hedge, and again, it kind of typically doesn't move in price. It's just that your dollar decreases in value, meaning that you have to have more dollars to buy the land. And you guys are looking at a chart here on the screen of historic cash grain prices, the same chart I use multiple times. NAS data from the USDA, which is how they derive a lot of their stuff. And you can see we're down here to about 437. And you can see during the and if you when I say you guys can see, I hope you guys are watching the screen here, but this would be during the original trade war in this time frame here, and you can see these prices, and then you have a calendar average. And if you look at the 411 price on that screen we're just at, this is a U.S. government inflation calculator. 411 2025, that would have been 2018. 411 in 2019, would be 513 in 2025. And we were getting some pretty large government direct payments during that time frame. So as you can see, inflation adjusted, we've by no means kept up with current grain prices, and we're by no means getting direct payments. Now, this government CPI calculator is not necessarily accurate. It basically, in a sense, we'll talk about it more as we keep these videos going, probably would be about 50% low. Alright, check this chart out. This is on macrotrends.net. This is a corn price chart starting at 1960, going to current date, starting at $1, ending at $9. And you see how this is a sideways band up until right about the time we went off the gold standard. And you see how there's a sideways band, which I put orange lines around, from the end of the gold standard until approximately the '08 global financial crisis, the big going broke, the massive quantitative easing. And what do these dates have in common? This is at which both times money basically ended. This is at both times where money was extremely devalued. And so we had a sideways band, we devalued money. We had a sideways band, we devalued money. Now it appears we have a sideways band. What I mean by trading by band, I mean trading band. You can see it has a top and a bottom. It's like a sideways channel. See the orange lines? See the lines? So this was about 4 and this was about 2, so that was your trading band, $2 to $4. Your trading band here's 8 and seems to be about a little over 3. And if you strike an average in that, you're looking at about mid 4s. And if you struck an average before, you were probably talking in the mid 2s, maybe $3. Interesting to see this on a long-term chart. So if you look at this, this would be your rocky years from the Great Reset of '08 in through the quantitative easing. This would be your Donald Trump tariff years, and here would be your COVID spike. And then they devalued money heavily right about in here. And you see how this didn't go all the way to the bottom? You know, maybe there's a chance that we just started a new trading band. I'm not sure. We'll see how it plays out. Trades or business cycles, they never go in a straight linear line. This would be a linear line. This is how they go, ups and downs. But really all it really matters when you start to evaluate these things are the averages. So if this was corn, and you're in a trading band, and you get some dry years or something happens, and you end up going down, up, down, all it really matters, you have to look and you have to level out the peaks and the valleys. And that's called an average. And the average for corn is oftentimes long-term, very flat or consistent, as we saw on those long-term charts. Whereas you start to look at like the Dow Jones and you average it out, being the stock market, it's at a much faster rise. It's not a flat line across the screen. It goes up. What is a real rate of return? A real rate of return would be if your annual inflation rate is 2%, and the Fed keeps it there, and maybe that's where you're starting to see commodities in a period like this. And this Dow Jones is averaging annually, say that that's a year, 8%. Well, if inflation's gobbling up your 2% buying power, that means your rate of return was 6%. But when you look at something like corn, maybe that was the same time frame, and you average it out, and if inflation's going up by 2% annually and there was no rise, then you had negative 2%. Or maybe corn, which by the way I did do the figures on that, it actually rose by about 1.5, about 1.3 to 1.5%. If inflation was 2, according to the Fed, then you still lost 0.5%. In other words, you've been in deflation. In other words, you've been losing money, whereas the stock market's been making money. You can simply go to Google and you can look up like a Dow Jones, and you can click on max or whatever amount of years, and it's kind of neat because it starts clear back here in the 85 and it goes up here to current date. But then you can see the percentage. It comes up with a calculator for you of how many percent up it's went, and you calculate the number of percent of rise and then by the year. You can do the same thing with corn and go in here to the max number of years, and whoa, it goes red, and you can see it's actually been in long-term decline, as the line actually has a downward slope. So if we have a continuous rate of inflation, but we actually have almost long-term decline in grain, that tells you a lot about what's going on with farming. And you guys can go online and fact check this all for yourselves, and you can use about 1 million different calculators which will all spit out the same thing. And the most important calculator is the one right here on your screen on your mobile device that you can just plug in all the numbers and come up with your own formulas. Now, one of the things that's happening to farming, and the reason this is all starting to go south, is because of this. This is the USDA trend line corn yields. You see this gray line? That's your trend line. That's the one they base the bullshit factor off of every year, where they say on trend line yields, your yields are going up. Well, trend line yields look to me as they're pretty much meaningless, because you can see right in here about that 2012 drought, that huge drought we had, and the seed corn companies invested piles of money into more modern, more drought-resistant hybrids, and you can see what happened immediately right after, of how these yields basically just go like that. And if you really want to get technical, you could say that maybe there's just a hint of an uptrend there, but you can definitely tell that the line I just drew is a lot flatter than this gray line. So this time period, which is over 10 years, is basically flat. In other words, nationwide scale, we have not increased volume, and if we've actually had a slight decrease in long-term price in relation to inflation, or especially in relation to inflation, that's why farming's in trouble. Now, if you're increasing every year at a rate that was with inflation, more like the gray line there, you'd probably be doing okay. So next year, when they spit a number out, they say based on trend line yields, ignore it, because now you know to just base it pretty much off of these numbers. And if you ended up at 179, you started at 171, and you're at 176 in here, you really didn't increase much. So at best, I would be looking at maybe a down year. And you can see how about every so many years, it again kind of just goes flat sideways. Kind of, average it out sideways. Then here comes a big technology factor. And then we go sideways again. I knew when I started making these YouTube videos I wouldn't get a lot of views. And I'm going to hold my thumb over this guy's name here, but this is a... I hate to just put people's personal information on social media, but anyway, this is a quote here. This is on a Facebook group. The impact of the centralization of our economy in particular, and I'm holding this up close so you guys can read it yourself. In particular, the final nail in the coffin of honest currency in '71. In other words, he's talking about the end of the gold standard. So I posted something about this, shows up in grains, and then over on Rick, I don't even know how to pronounce this guy's I cannot pronounce his last name. You can pause the screen and pronounce it for yourself. But since the 2018 Farm Bill, cotton costs have averaged cotton costs are up an average of $200 per acre, and interest expenses are up more than 200%, while fertilizer costs have more than doubled. And that's all with negligible yields in the last gains in the last 20 years, which is in price stagnation going back to 73, 52 years over 2 generations. Time to rethink And this was the guy that posted it. And this is pretty much what I was just talking about, is that the inflation here has outpaced your rate of yield gain. You know, you've not been able to keep up with inflation, in other words. And it shows on his chart, dissecting this in live time here. There's looks like trend line yield, and then you have probably a inflation, or maybe that's probably a margin. So that's probably a margin. And then you have actual yields, and you can see how we're not keeping pace with it. But then we zoom down here to the comments, and the author of this wrote that 65 cents would be worth $1.20 today, and you can see the US dollar devaluation chart. And then we get into the comment section here, and gotta hate putting people's names up here. I know it's a public website, but there may be, you know, privacy of the group. We'll cover this one. Yet farmers through the Farm Bureau lobby for more government subsidies and control, get government out of farming, and let the dominoes fall where they will. Well, to say that there, buddy, you're talking about getting government out of every single thing in the United States and going back to complete freedom. And complete freedom's not always free, because if you have complete freedom to do as you want, and somebody has more money or more of a monopolization than somebody else, or a leg up advantage, obviously they're going to have a big leg up. The advantage was fair and even government. That's the problem. Government insurance, farmers will cease to exist, and well-managed farms will survive. So what do you want? Just a bunch of farmers that go broke, cause a net shortage, and then that's going to cause a extreme inflation in the goods, and that just wants a bunch of other people to go jump back into it. This is the typical type of comment that I see all too often on social media, and they're just based on complete ignorance. And he concludes, John Deere will get its wings clipped and become accountable to farmers. John Deere, if you average out their tractors, is about 6% per year. And the CPI horrifically understates inflation. So if you figure real inflation, John Deere's just keeping up with real inflation. It's just the problem is your commodities haven't. So, accountable to farmers, accountable to what? You mean you want them to go into losses? We'll get into the public social media comments at a later date, because we've only hit the tip of the iceberg in these videos. But say this green line here is commodity prices. Say the black line is your input prices. And the difference between the two, that's your margin. And as your commodity prices tend to rise, they will rise faster than your input prices. You'll have a greater distance between the two. That's a profit cycle. But then the inputs catch up and they outpace it, and as you can see, your prices, your commodities drop faster than your inputs, and that's a loss cycle. And eventually we'll get back down here to where there's a difference between the two of another margin. You know, that's what's going on right now, and we're in that transitional phase. However, to work out, the problem is this margin has become smaller and smaller through every one of these cycles. When commodities go along and they have a rapid rise, and you have your costs, and then eventually they catch up, the problem is when these things all go into a margin, the problem is these commodities come back down like this, and they maybe go on like this. And the problem with this is it only levels, or maybe even continues up a continuous line, like your groceries. And then you end up with a lot larger gap between the at the store costs and the raw commodity costs. And we've only hit the tip of the iceberg in these series of videos, and we'll come back to these social media comments at a later date, because I could do probably 3 videos just based on that one guy's comment. And there's hundreds and hundreds just like those comments out there. I've seen that kind of comment over and over and over again. We'll talk about that as we continue on with this series of videos, so bear with. bottom line is currency devaluation domestically, meaning within the United States, while on a global scale has actually appreciated, is the absolute two worst simultaneous things to happen in regards to what happens to a farmer. So thanks for watching, and we'll talk about a whole bunch more of this in the future. I wasn't going to respond to that guy's comment on this video, but I figured the hell with it while we have time, just as well add a little bit to the end of the video. He writes, yet farmers through the Farm Bureau lobby for more government subsidies and more government control. Well, by subsidies, I'm assuming he means direct payment, but if you actually Google the term subsidies, which most people don't, it actually means tax codes including that. Well, tax code has all sorts of deductions. So if you want to eliminate subsidies by all true measure, you would actually have to eliminate 100% of all tax code. Period. It would have to be 100% of anything to do with taxes, IRS, any of it, 100% null, void, and gone. Because if you want to argue who's getting what subsidies or how much of it, and feels like they're getting a, quote, fair shake of those subsidies, then you open up a debate for what we exactly have in government right now. There's a never-ending battle of power between who's getting what and how much. Now, if he actually meant subsidies in the form of direct payments, yes, that is most people's solution to the problem of needing money, is to actually give more money when that is the root cause of the problem. Then he writes, get the government out of farming and let the dominoes fall where they will. Well, people with money, because of that, would probably be the biggest carpetbagging land takeover in history. And there potentially could even be ground go fallow if this were to happen overnight. Government insurance farmers will cease to exist and good, well-managed farms will survive. So if your entire game there is survival there, buddy, that wrote the comment, what are you getting at? Are you looking to make money as a business, or are you looking just to survive on a few stragglers that made it through? And what about all the ground that didn't? Just say abruptly enacted this plan and 70% of the farms in the nation went out of business, and you end up with 30% of the land being bought up by billionaires or wealthy investors, and you end up with a net shortage of product, and a net shortage of products going to lead to higher prices, which would allow you to pay those now absentee landowners more money for rent, and you just created a new version of boom and bust cycles, which is what you have now, but in a different way. And then at the end he concludes with, John Deere will get its wings clipped and become accountable to farmers. Yeah, John Deere's got a good profit margin. Most companies or businesses do have a good profit margin. That's the problem with farming. There's no margin. And to just steal from them to give to yourself, I can understand it, and I understand that becomes the mentality. But at the same time, if you look at true adjusted inflation, they've really done nothing on the price of a new tractor except for keeping up with it. Maybe the bigger question here, instead of getting government totally out of the thing, would have been to have a much more honest and much more balanced government, which is a big problem. And as far as his money comment, the only way to get that out of there would be to basically eliminate your central bank, which he never once mentioned in his comment. And that's the problem with people that comment like this, is they ultimately are just mad and hateful, but then place the blame in the wrong places. And they're bitter at the world for what it's became when they don't understand the reasons of what or why it became that way, which is what I'm hoping to do on this channel, is to explain the what's, where's, and whys, and the people that take the time to watch it over time will eventually understand it as the way I do. And if you have any questions, ask along the way. As for that commenter, yeah, there's not much hope. You can pretty much destroy him in debate, at which point he'll just become increasingly angry at the world. And that's one of the main reasons that the United States is falling apart.